May I request everyone that we are going to start this session? Well, this is the last session, and it's on G20 and international tax reform. I noticed that since it's the last session, we have lost some people, but what we have lost in quantity, we have made up and more in quality, because I see Montek and Professor Huda right here in the front. So we have lost nothing at all. I guess expressions like BEPS, which I didn't know much about, but read up just before this session, base erosion, I know the concepts, but I didn't know it was known by this acronym BEPS, base erosion and profit shifting, issues related to double taxation avoidance agreements and the gains and the risks which stem from them, transfer pricing, tax arbitrage, tax avoidance, and worse still, tax evasion, retrospective taxation. I guess the cases of Apple, Google, Starbucks are cited often enough in the case, in the sense of profit shifting, BEPS, and so on. Okay, I'll stop there because I've come to the end of what I know about taxation, except that there are some other issues with regard to taxation when it comes to tax havens. I don't quite know whether the speakers today will also talk about tax havens. I remember some time back seeing a BCG study which said that there is about $8 trillion worth of funds in tax havens, and then McKinsey came out with a report, said no, but if you take also into account the funds which come via tax havens, is actually somewhere around 21 trillion. So we are talking very large numbers when it comes to tax havens, but as I said, the topics which could come under G20 and international tax reform are so wide and so deep, so it may not be possible within the limited time that we have, just about an hour and a half, and we want to keep at least half an hour for questions and answers. So may I suggest that we begin with Mr. Barry Sterlin, and then Satya Podar, and then Professor Ashima Goel. Over to you, Barry. Yes, please, whenever you are comfortable.
Thank you. Thanks, Jamini. Just in terms of this year's agenda, as I outlined the framework this morning, growth is, or kick-starting growth or turning up the dial on growth is a key part of the agenda. The other one that Australia has pushed is under the theme of resilience, and that focuses on the financial regulation issues we've talked about, but to us tax is a key part of that. What we've found in the last few years is that the very prominent cases of tax avoidance, legal tax avoidance and evasion are having an enormous impact on people's feelings about legitimacy of our domestic tax systems. I think it's come onto the agenda big time because of the pressure different budgets are under and the effort that governments are going through to engineer fiscal consolidation, so that brings a sharpness to this question. And my minister reliably tells me that when they do their work as politicians, their private polling or their thinking about what issues resonate with the public, this one ranks right up there. The tabloid, I had a tabloid journalist in Australia, and this tabloid is not known for sophisticated economic thinking. Nothing else in the G20 agenda mattered. She wanted to ask me about the announcements coming up on the common reporting standard for automatic exchange of information, tax information, and I said, you want to write a story in this paper on this topic? And she said, yep, this one, the editor will put it right on the front page. So this subject has a unusual resonance, I think, and you can see why. So that was some of the background. Some of the basic work had been going on for some time, but I think that probably one of the most significant outcomes of last year's, the St. Petersburg Summit, was the agreement to push ahead with this agenda under the G20 cover. It was halfway through the finance track last year, this was a minor topic often raised in the other business, and together with a few other countries and Russia's cooperation, it moved to a topic of its own. And I think the expansion of this from an OECD project to a fully inclusive G20 process has been a really important development, and I think builds on that topic I spoke about this morning of the maturity of the organisation. So the agenda this year is broken up into a few elements. There's the efforts to combat tax avoidance, and that's where the so-called BEPS, the base erosion profit shifting policy work, comes under. The next set really surrounds exchange of information, and which is mainly illegal tax evasion that we're talking about. And finally, we've tried to shape the development agenda this year so that it's part of the clearly part of the mainstream agenda rather than the approach that I think you outlined last night, Montek, the long list of subjects that could be talked about anywhere. We decided to try and make the development agenda this year closely match what the core agenda was about, and in a sense expand and deepen that for developing countries. And so there's a very specific set of work to translate both of these agendas, the avoidance and the evasion agenda, into mechanisms that make sense for much less developed tax systems. And so the work within the development working group is focusing on how to implement these quite complex arrangements in a way that makes sense for developing economies. The basis of this work is that it's a global problem, requires a global solution. The public pressure that I talked about at the start, combined with, if left alone, I suspect would raise quite significant risks of unilateral and less coherent actions. You could see a return to double taxation, and disputes like this could harm jobs and the very process of globalisation. So there's quite a strong view that we need to work on this collectively. That means you need outcomes that are inclusive and have buy-in from a range of stakeholders. That the whole G20, the broadening of the OECD to include G20 members as fully equal, a fully inclusive process was important. Indeed, several of the key emerging economies, India is one of them, are actually part of the steering group for this project. So it's not just my view, apart from there might have been a couple of wrinkles as people got to know each other, the process feels like a quite deeply inclusive process, at least in the decision. There's still issues of getting that message out to and consulting with developing the countries outside of the G20, but the adoption of this as a G20 project has been important. I think India's played a very strong role in that. Bank secrecy has been one of the issues. India is one of the non-European countries that has been pushing to be early adopters of this automatic exchange of information. So it's not just that the process is inclusive. There are some OECD countries are part of an early adopter process. Some, like Australia and others, may not be for various reasons. There's a mixture of perspectives, and I think we're making substantial progress. And in Cairns, what you can expect will be progress in the 2-year base erosion and profit shifting action plan. So it was quite a complex action plan, and if I went through the topics, it would there'd be a few tax experts that understand all the dimensions of that. But 15 actions have to be delivered over 2 years. Unprecedented push to get global cooperation on that. Around half of those are due to be delivered this year as part of by Cairns, and so the OECD G20 process has been working behind the scenes. The that policy process has to finish next year, and so in a sense, many of the projects that are finishing this year are sort of interim type findings that are connected to further findings. The sort of issues being dealt with in the BEPS action plan, there's a lot of work around transfer pricing, several actions around that. There's been analysis of sort of harmful tax practices. These are sort of artificial tax practices that distort the location of activity. There's work around updating the treaty system so that it accounts for these issues. And there's been a sort of a further analytical piece about how to address the digital economy and the challenges that poses for tax. The key issue here where the policy process has become disconnected from current realities, there's two big issues. There's the rise of intangibles as an important element of production, brand particularly, brand and networks sort of benefits combined with the ease of doing digital business. I think those two things connect. They raise greater risks in where you can locate, in a sense, the value-adding activity and create a greater ease in how you can move it about. And the digital work that will be presented in September, it suggests that you probably don't need new frameworks to handle digital, and many of the other activities across the BEPS action plan will deal with many of the issues raised by the digital economy. And there's a growing sense that it's not just individual electronic e-based companies, but the whole process of digitalisation. I've heard one of the experts say that it's just with some of the names that we've heard prominently in the public debate, they're just at the leading edge of this. They're particularly innovative companies. They've managed to find every boundary and push it hard early because of the sort of culture it comes from, but this is going to be right throughout the finance industry, the commodity trading industry, and every part of the economy. And so you have to have solutions that aren't sort of sector specific but are based in principles, and so dealing with transfer pricing properly and other things will actually capture much of the issue raised by the digital economy. So that's the base erosion and profit shifting. There'll be some progress, but it's really in a sense, substantial progress against that very big two-year agenda. The second element is a new global standard for the automatic exchange of information. This is largely financial institution information, and their protocols for automatically exchanging between countries that have agreements. So the protocol's been developed. The last piece for this year is to produce the implementation approach to that. As I said, the several European economies are going to be early adopters of that standard because they already have similar legislation in place. I understand India is interested in that. And that will make it very hard to evade taxation because transactions and account details will be automatically exchanged and matched between tax administrators. And so that's dealing really with the evasion set of work. And I think by the end of this year, there'll be a strong sense of a pathway to implementing this much more rigorous system. And then in the tax and development space, there's been a lot of thinking about while I say the base erosion and profit shifting agenda has been inclusive, it still, I think, reflects its origins. It had a very, it was dealing with the problems of more sophisticated economies, and as the development discussions happened, there's a sort of sense that it misses some issues that are particularly important for low income and particularly smaller developing countries, and these are to do with the provision of tax incentives to set up in countries, things that aren't the sort of transfer pricing, more sophisticated, and just the provision of tax incentives, the risk that poses for corruption and tax base erosion. So there's going to be some more work, I think, commissioned to deal with some of the issues in this space that are more specific for developing economies and low-income countries, and then also how those low-income countries can benefit from the automatic exchange. This is the sort of thing that sophisticated tax administrations use, and we're talking about countries that have trouble collecting some basic taxes. I think there's got to be some attention given to capacity building and locating that within a broader domestic resource mobilisation framework, because you don't want to distort the development of a tax administrator like a Papua New Guinea or the small islands in the South Pacific with this highly sophisticated stuff when they're having trouble doing the basics. So we've got to think about that whole capacity and some pathways for these countries to begin to benefit from it without having the full structure. So the issues that are being talked about are whether you can begin this on a non-reciprocal basis for low-income countries, so they don't have to put in all the domestic analogues for it, but they can start to benefit and then graduate to a full reciprocal exchange of information. And then the new element that at least the presidency is exploring, the Australian presidency, is whether we can do some more things around practical cooperation between tax administrators. Our own tax administrator has worked with several others, and they're trying to do sort of common audits and investigations of certain sectors in the world economy. So these companies arrange their tax affairs from head office, whereas each of the tax administrators in each of the country deals with it from a country perspective, and just having more conversations, checking the information provided. We may in fact find that some of this avoidance, which we thought was within current rules, is actually pressing the boundaries of current rules, and so could actually start addressing this a little bit earlier. So we're trying to develop some initiatives to bring a really immediate practical element to this through the OECD Tax Administrators Forum. So that's the sort of space we're in, and I think we were talking at the table last night, one of the issues for this year is both delivering on those important agenda items for this year, but I've had some experience with domestic tax reform, and I think it's very important to keep circling back to the rationale for why we're doing this, because tax reform starts with people agreeing to high-level principles. It's not good to have double non-taxation, it's not good for money to be shifted around like this. And then as you work through the rules, it gets very sharp. You actually start getting into where the tax, once you tax it, which jurisdiction will get that, and how it'll affect the interests of very large companies. So as you move from the general high-level pronouncements of St. Petersburg that this is a good thing to the actual things you do to address it, I think the debate gets much harder, and I think this will require quite a major push from both governments and civil society to push this through to conclusion, because it'll get sharp, the lobbying gets harder, and then at the end of 2015, of course, that will be developing the international standards. The hard task of implementing those within domestic jurisdictions begins, and over time what you hope is that we maintain that sort of integrated international approach. We've developed new modes of cooperation to handle this ever-evolving area, and we've developed a new and really productive area for G20 action to address an emerging issue. I'll stop there.
Thank you, Barry. I think we can now move on to somebody who is an expert from the private sector. Mr. Podar, please.
National tax reform. It's such a vast topic that you can cover the entire world, the globe, by the word international, and there's so many dimensions of it. So Vijay basically suggested to me that I can talk about anything but VAT, and that's true. That's the only direction I got from ICRIA, that you can talk about international tax reform and choose your topic as long as it's not a VAT. So Vijay, you are safe. What I'm focusing on is clearly issues linked to BEPS debate, which G20 is going to discuss, exchange of information, reporting protocols. But rather, this topic has been discussed in so many forums around the world. I'm really going to reflect on my personal observations as a person who is not actively involved in international tax planning, but hears a lot about frustration of the tax authorities as well as the taxpayers. And my overall view is that international taxation rules are really designed to divide the pie between various countries who are involved in international transactions. And those are basically the source countries where the income is originating, and the destination country or the residence country where the income is ultimately received. So the conflict here, which the international tax rules are designed to resolve, is between the right of a source country to tax income where the income arises, or the right of the residence country where the income is ultimately going to the recipients. Now, that system has evolved, and it is going through tremendous stress. And that's what the BEPS debate is all about. Are those rules of the game for dividing the pie functioning well? If not, why not? And in those rules, again, there are two types of issues that have come up. One is simply dividing the pie in an inappropriate manner among taxing jurisdictions. So the size of the pie is finite and fixed, and you're really dividing the pie among various parties, various countries. But the more important issue, which is the issue in the BEPS discussion, is that the size of the pie is shrinking through base erosion. So it's not a question of just dividing the finite pie, but also making sure that in the process it does not get shrunk. Now, what is the role of India? And what is the position India should take in the G20 or OECD BEPS discussions? And let me just give you my bottom line observation. The rules do require a change, and India's interests are no different than of other countries in making sure that they get the fair share of the pie, and that the pie is not shrunk, that the pie remains a good-sized pie, and the base cannot be eroded through evasion or avoidance. But I find that based on my experience with the policy-making process in India and the tax administration disputes, that Indian approach for strengthening those rules is not kosher. Essentially, Indian administration has tried to bend those rules to get what they believe to be a fair outcome. And this has led to a lot of disputes and lot of disharmony between the taxpayers and the tax administration. And I'm going to focus on 3 or 4 issues where the Indian approach has not been appropriate, and what is the position India can take going forward in the G20 discussions. Now, some basics. The international tax regime today was designed at a time when the global trading patterns were quite different, but the international trade and global trade patterns have changed dramatically because of globalization. And aspects of that globalization which have impacted upon the tax system are free mobility of capital as well as labor. When the rules were developed in mid-60s, labor was relatively mobile and capital was mobile. So, but today that's no longer the case. Increasingly, labor is just as mobile as capital. And that requires new set of rules for deciding how to tax not only labor income, not only capital income, but also labor income. Removal of regulatory borders So you have more trade than otherwise. Good example, in India, you have lots of foreign exchange controls, import-export controls. And because of those controls, it was relatively easy to define the tax pie from international transactions that was taxable in India. But with the deregulation or less regulation than before, it's a lot easier to do the trade, and the trading patterns, investment patterns have evolved into many more complex structures, which Indian tax system has not dealt with systematically. Then, of course, the shifting of the manufacturing to low-cost locations, mainly through the growth of intangibles, growth in telecommunications, and the role of technology, technological development, which has made the globe a village because the distances have shrunk dramatically. Now, this is a simple chart that illustrates how the supply chain is dispersed today compared to what it was before. So the supply chain in this chart is basically reflecting that the value which is added in the production process is no longer based in the country where the value added is consumed. So if you look at the final point here, which is, say, North America, that's where the goods are sold, but the markets only account for roughly 1/3 of the value added. So if the total value added is 100, roughly 1/3 takes place in the country where the goods are consumed. 1/3 takes place in the countries where the output is produced. Now, and where is the remaining third? The remaining third is going into countries where the inputs to output are produced. So basically, the production itself, value added, is now bifurcated into different locations. Inputs come from one country, and the production takes place, assembly may take place in a different place. So the total value added is now roughly divided 1/3, 1/3, 1/3. 1/3 in the place where the consumption takes place, 1/3 in the place where the production or the final assembly takes place, 1/3 in the place where the raw materials or the parts are produced and manufactured. Now, in that environment, the critical question is, how do you define the source of value added? And is that definition, is that division of value added where the profits tax is to apply, is it fair or is it being manipulated? You've heard the example of iPhones. The total production cost is roughly 5%. Remaining 95% is something other than production cost. Could be the R&D, development, design, branding, and all those things. So in that environment, the rules that we have historically developed are not working, because even if you go by the place where the value added is created, you're only capturing tax on the 5% of the value. How do you locate the place of the 95% remaining value? Which country applies the tax on that? And that's a debate. Other aspects of the debate are tax competition between countries. Now, historically, the tax competition was between industrialized countries which had more or less comparable tax rates. But now you have the tax havens come into picture, which have very low tax rates. So European Union has to write rules about harmful competition. And they have explicitly legislated that EU member states cannot have a corporate tax rate less than 10%. In fact, Ireland used to have a tax rate of 2 or 3%, and because of the EU pressures, they increased their tax rate to 10%. But now what you hear in the newspapers is that even the 10% is only on paper. They have a rule that the corporations are subject to tax in Ireland, even if they carry on activity in Ireland, provided the place of management and control is housed in Ireland. So all the companies have to do is to put the place of management and control in a tax haven, and all the income is shifted there. So the tax competition has become a very serious issue, and the role of the G20 or BEPS discussion, OECD, is to how do you curtail competition? And the two ways of curtailing competition, one is to say, even if you have the place of control in a tax haven, you cannot allocate all of the income to the tax haven. So you define rules for allocation of income